Let's talk about a company you've probably never heard of, but from an investor's point of view, it's a fascinating story. We're diving deep into Spirax Group, a true industrial giant that's seen it all and is now making a huge pivot for the future. So, let's get right into it.
Okay, let me just throw a number at you. 56. That's how many years in a row this company has increased its dividend. 56 consecutive years. We're talking through every single market crash and recession for more than half a century. That's not just a statistic. That is a massive signal of a seriously high-quality, durable business. And that brings us to the big mystery, right? If this company is such a rock-solid performer, why on earth did its stock valuation get absolutely hammered, basically cut in half? This huge disconnect between its amazing history and its recent price, well, that's exactly what makes this such a compelling puzzle for investors.
So, to solve this puzzle, here's how we're going to break it down. First, we'll look at the company's long history. Then, we'll unpack its incredible business model. After that, we'll get into the perfect storm it just sailed through, analyze its huge strategic pivot, and finally, bring it all home to the investor's bottom line.
All right, first things first, let's get a feel for who Spirax Group really is. This is no flash-in-the-pan tech startup. We're talking about a 135-year-old veteran that has proven it knows how to adapt. So they started way back in 1888. But honestly, for us as investors, the really crucial stuff has happened just recently. The acquisitions back in 2022 completely changed the game for them. And that rebranding this year, that wasn't just a paint job. It was a deliberate signal to the market that this is now a powerhouse group of 3 distinct, world-leading businesses.
Okay, so you got to ask yourself, how does a company not only survive, but thrive for over a century and raise its dividend for 56 straight years? Well, it all comes down to what is, frankly, a beautiful and exceptionally strong business model.
85%. This number right here, this is the secret sauce to their stability. A full 85% of Spirax revenue comes from their customers' day-to-day operating budgets. We're talking essential maintenance and repair stuff. It's the kind of spending that has to happen even in a recession, and that creates an unbelievably predictable and resilient stream of cash.
And this is where it gets really interesting. This is the company's true competitive advantage. It's human moat, if you will. Spirax has over 2,100 expert sales and service engineers on the ground, literally embedded with their customers. These folks aren't just taking orders, they're trusted technical consultants.
And the scale here is just staggering. Being 10 times larger than your nearest competitor is a massive advantage. It means they have this unmatched physical presence inside the world's factories. They literally walk the plant, solving problems, building that crucial trust, and finding new opportunities that actually generate around 40% of the company's revenue. They create their own demand. It's incredible.
And all of this creates this powerful, self-reinforcing flywheel. You have this huge base of their products out in the world that needs constant service. That generates a steady flow of high-margin cash. That cash then pays for that massive sales force, which goes out and sells even more products, making the installed base even bigger. You see? It's a virtuous cycle that just keeps spinning and is incredibly hard for any competitor to stop.
So, if the business model is so fantastic, what on earth went wrong in 2023? Well, to put it simply, the company sailed head-on into a perfect storm of some very specific and very powerful headwinds.
The key term to understand here is destocking. So after the pandemic, a lot of companies, especially in the biopharm space, had built up these huge stockpiles of supplies. When demand finally cooled off, they just stopped ordering new stuff and started using up what they already had on the shelves. For suppliers like Spirax, that meant orders just fell off a cliff.
And you can see the damage right here in the numbers. It's like a tale of 2 completely different companies in 1 year. The core steam business, STS, was a rock, growing a healthy 8% in a really tough environment. But the Watson-Marlow division, which is heavily tied to biopharm, just collapsed, down 19%. This adverse mix was brutal because the part of the business that tanked was one of their highest margin segments.
To their credit, management was totally upfront about it. They basically admitted that this destocking cycle was way deeper and lasted way longer than anyone had expected. That kind of honesty is important because it helps frame this as a temporary industry problem, not some deep flaw in their own business.
But here's the thing. While the market was freaking out about that storm, Spirax was already making a brilliant strategic pivot. They were busy transforming themselves from a company that optimizes old-world systems into a key enabler of the entire energy transition.
And this shift is absolutely crucial to understand.
For a century, their job was basically making fossil fuel systems run better. Now, their future is helping industries get rid of those systems altogether and switch to clean electricity for all their heating needs. I mean, think about that. That's a move from a mature market into a massive, multi-decade global growth trend.
And they didn't just talk about it, they went out and built it. They made two huge acquisitions, Volcanic over in Europe and Durex in the US. And just like that, they created a new world-leading business in electric thermal solutions, or ETS, and expanded their potential market by more than £6.5 billion.
And you can already see how real this transformation is just by looking at the numbers. This new ETS business, it's not some little side project. In its very first full year, it already makes up nearly a quarter of the entire group's revenue. They've effectively built a third pillar for growth, almost overnight.
All right, we've seen the resilient past, the painful present, and the really promising future. So let's boil it all down. What's the bottom line from an investor's perspective? Well, this chart really tells the story, doesn't it? The impact on the stock's valuation has been absolutely dramatic. At its peak in 2021, the market was willing to pay almost 54 times the company's earnings for the stock. After the storm of 2023, that multiple has been roughly chopped in half. The big question is, was that price drop justified, or is it a massive overreaction?
So here's the tug of war for an investor. The bull case is clear. You get that durable moat, that sticky recurring revenue, and now a huge new growth engine tied to decarbonization, all at a much more reasonable price. The bear case? Well, the stock still isn't exactly cheap. That biofarm recovery could take a while, and, integrating your largest acquisitions ever always comes with risk.
After weighing all of this, the source analysis we've been walking through comes to a pretty clear verdict, a buy recommendation. The bet is simple, that this company's long-term strengths and that bold strategic pivot will ultimately overpower its short-term challenges. And that leaves us with a critical question, the one you have to ask yourself. Was that perfect storm in 2023 a giant warning sign to stay away? Or was it the exact moment of weakness that created the perfect entry point for a long-term investor? That's the billion-dollar question.